Good evening, readers. So yeah, it's just a quick, hopefully a quick video. Hopefully for your sake, a quick video. But yeah, just sort of go through this article I just written. So 2024 annual results, which is this here, and let's grab the presentation deck. This here. So what I've done is I've just worked through the numbers. See, done an update on the trading update. So a lot of the numbers were pretty much as we expected them. There wasn't any great surprises. Comprehensive income, just kind of call this bit out. So this 100 million and 100.2 million adjusted comprehensive income. Nowhere in here will you find it. But what I'm doing is I'm taking the unsettled hedges, which is the unsettled hedges, which is these unsettled financial instruments. So basically taking this 189 minus, okay, because these relate to a future time period in the same way that last year we didn't actually believe that DEC made 1.08 billion profit. You know, that gain wasn't a real gain, as in we didn't suddenly have, because if they had made 1.08 billion, we would have all had 30 quid returned to us, because that would have sort of given us vast dividends for years to come. So you know, these derivatives, the way these work is that you basically hedge that prices are going to be either a minimum or a maximum in a future time period. Maximum that you can take advantage of. If it's below that you can buy it at a discount, and a floor at the opposite, that if it drops below that you still get the floor price. You know, that it's sort of like a minimum. You're basically locking in a minimum price, and sometimes you'll do a bit of both to cover you, so you won't get a huge upside if the price goes shooting up, but you're not going to get a huge downside either if it goes shooting down. So, but all of these instruments are all sort of in the future, so we don't include future income in the 2024 results. So why should we include future costs? But one of the things that, and it only struck me today, was that, well, why do we consider all of the future liabilities as well? I mean, they are liabilities in the future, but there are going to be revenues that, you know, essentially they are future cost of sales. That the cost of having a hedge next year, as in this year, 2025, is so if we went and looked at the hedges, they were down here somewhere. The hedges, let's just find them there. Here, I think. Hedges is yeah. So these hedges are, there we go, number 13. These hedges, so like this minus 67 million I talk about in the article, for example. So these hedges here, so there's, what is it, about 110 100 million that there's a future loss. But these future losses is basically that you're locking in a $3.30 price minimum. So in other words, if gas goes to $2, there's a $1.30 gain, because you're getting $3.30 from the counterparty, whoever you're gambling with or buying the swap from. Because it's not gambling, it's the opposite of gambling, actually. It's gambling not to have a derivative. But this 100 million fair value loss in a future period, i.e. this year, relates to the fact that there'll be $1 billion of revenue this year that generates a profit this year. So this sort of, you know, the way that they account for it, where we say, oh, you know, we've got this 600 million worth of losses in a future year, this 661 million loss of future contracts stretching out into, you know, sort of the year 2032. I mean, there's another sort of 7 years of future profits to offset against that minus 661. So anyway, what I did, and I thought it was actually, I thought, why have I not done this before? And I'm sorry, I'm zooming ahead, but I sort of said, well, let's redo the balance sheet last year, this year, where we just take out all the derivatives because they're just noise, and then what actually happens to the numbers. So we see, well, I've included it twice by the looks of things. I have to edit that. Um, but yeah, we see basically these acquisitions. We see another 400 million worth of properties, which is the oak tree, the East Texas 2, and so on. And then this 2905 doesn't include Summit, doesn't include Maverick, so it's all the stuff up until the the end of 2024. So it's not it's not everything, but it's kind of including all the things like oak tree and so on. So again, this was sort of Crescent Past, East Texas, and so on. So again, some increases here, increases to the deferred tax. So this deferred tax was because of the derivatives, the company made a loss during the year. But actually, as I say, if you take out that 189 unsettled, because unsettled means it relates to a future period, then what was on the face of it a loss, reverse the 189 back out, and it's then at a profit. So the profit being 100 million, this 100.2. So that does include the 151.5 of settled hedges. Settled means they were settled in 2024, so they relate to 2024. The production, 132,000 barrels of oil equivalent per day. The average in the fourth quarter, so post Oak Tree, post um, the three acquisitions, East Texas and so on, that the average for the fourth quarter was 141, and the exit rate at 31st of December was 144. And obviously, since then, there's plus Summit, um, plus Maverick, so the 144 will be higher still. And if we went and grabbed our Maverick combined, we would see, so it's basically adding in. Now I've used that number there, which is the end of September, so it's actually excuse me, 3,000 barrels higher than this number here. So we're looking at sort of 202, something like that. Obviously, with a little bit of decline, maybe 199 is not actually a bad shout for sort of March, April 2025, because obviously there's 3 months of depletion, but around 200,000 barrels of oil per day in the current year. And when you consider that that's sort of, that's 50% more, 50% more than the year than the year we've just been in. So adjusted EBITDA earnings 472. I do take people's point that EBITDA you're not including depreciation, which is why I like this adjusted comprehensive income, where we are taking the depreciation, depletion, amortization. I mean, the thing about the tax is because it includes hedges, so if you've kind of lost money, then you get a tax refund. If you've made money, you get a tax cost. So like actually using net profits not that useful, but using an adjusted net profit, and maybe an adjusted net profit before tax is the best measure to use for DEC. Free cash flow 170, really, so again, really good number. Obviously that's post capex, so obviously that they're forecasting for 2025 420, which is fantastic. I mean, that's again, it's a more than doubling of free cash flow. Margin 50%, revenue in 321, so 19.3 barrels per oil. adjusted costs 10.71. So, good margin there. The shorters have pretty much melted away. There's one left, and I saw they've kind of reduced themselves down very sharply last Friday. I imagine tomorrow that downward arrow, the arrow street is pointing downwards, and yeah. So yeah, anyway, that's 25. A couple of things to call out here. So as I say, the free cash flows massively increasing, and this FCF can be used for buybacks, can be used for deleveraging. I mean, when you consider that with 400 and so million free cash flow, your leverage could be massively reduced over the course of 12 months, and synergies as well. So they're looking at sort of driving down cost, which is normal when you've made acquisitions. You then look to rationalize them post acquisition. This 25%, 75% oil and gas again is good. Forward guidance and actually this I thought was worth calling out, that the forward guidance of 825 to 875. So even if we just take the lower number, 825, the forward guidance, and compare that to the 12 months to September, which was the 555 and the 380. Now, because Mavericks only happened mid-March, so we've lost best part of 3 months, that you can only really take 75% of that number, 75% of Maverick. So actually, when you compare it on that basis, even sort of using last September as the measurement, what we're saying is that this year compared to last year is going to be either sort of 10 million down comparatively. So that plus 75% of that would be 815, based upon it being the 825. Or if DEC achieve 875, that's a 40 million EBITDA growth, um, on top of historical. In other words, with depletion, you'd expect obviously profits to drop over time because of depletion. Uh, but countering depletion is the synergies and the workovers and all the different things that they're doing to boost production. So again, the fact that this is negligible to zero and perhaps even less than zero, so positive, that suggests to me that they're increasing by more than 10%, that they're depleting by. So again, really, really positive. It's not to say that that can be achieved every year, that it won't be 10% ever, but it doesn't look like it's going to be 10% or anything close to 10% in 2025, nor was it actually in 2024. The depletion, I mean, yes, there was a depletion figure, but comparatively, when you strip out the lower gas price, because the lower gas price obviously compared to 2023 had a massive impact. From a volume point of view, it's about 3% less volume year on year, 23 to 24. This slide, I mean, it was the first time that I'd seen them actually give guidance. This is a bit of an American thing to do, which I think is a good thing, actually. I think British companies should do more of this. That it's very welcome that they gave this guidance, and they also sort of gave this pro forma. Now they have given pro formas before, but pro forma basically means, if we bought Maverick on the 1st of January, then the numbers wouldn't be 825 to 875, they'd be 925, because obviously it's this 75% thing that I'm babbling on about here, that you've essentially got, between 50 million and 100 million of lost Maverick time, because Maverick's only coming on board in March. So that was really positive. Leverage of 2 to 2.5. Now, I looked at that and went, well, actually, that's not actually a reduction, because if you take the 875 or 825 and then sort of compare that to the debt figure being, let's just grab it down here, debt being this 1.5 and this, so 1.7. So it's sort of about 2 times. I think I worked it out to be 2.3. It's 2.35, at the moment or at the end of 2024. So to sort of say, oh, by the end of 2025, we're going to get to between 2 and 2.5 times. They're kind of already there. They're already there. So um, that suggests to me that either A, that there's going to be more acquisitions, which some readers will obviously roll their eyes at, or there'll be quite a lot of buybacks, and they did talk about buybacks today. So, right, I'm going to try and keep this snappy. I mean, a couple of things, negatives, just looking at through the numbers. If you actually take the first half, second half numbers, costs do go up by quite a bit. Now, some of this is just down to the fact that there's more production. Production's about 13, 14% up. So operating expenses been up by 18.7, suggests in real terms first half to second half, the costs are up by about 1.5%, something like that. And obviously DD&A is up by 0.5% or 0.25%, so hardly anything at all. But this figure I thought was quite a lot. But then I thought, well, there's probably quite a lot of people being made redundant and, sort of all that, acquisition of people and acquisition of stuff. Sorting all of that out always costs money, always takes time. So this short-term blip in G&A, I'm not expecting that to be sort of suddenly jumping from, because actually if you double that, and I did ask for a question today and wasn't granted it, but if they had allowed me to ask a question, I would have said, well, I can see that your G&A has gone from 116 to 140-ish. That's quite a jump, 21% is quite a jump. Are you sort of seeing this as a run rate going forwards, or bringing it back down again? And the same in terms of these, what was it? This bit here, LOE. So the leasehold operating expense up. Now this is a per unit price per unit. So this isn't sort of production related. This is per MCFE. Uh, Jumped quite a lot, 14 cents. Now, what I did was I said, well, the first half number was 073. The full year number was 080. So what I've done is I've basically just taken the difference, which is because production first half, second half was, obviously it was slightly higher, 13% higher in the second half. So that would suggest the this, if anything, is slightly higher than 087, or no, actually no, slightly lower. Thinking about it, but it's definitely sort of, for it to be average zero point 0.8, then it needs to have been more than 0.8 in the second half for it to offset this 0.73. Yeah. So that was, for me, was a negative. Obviously, the midstream reduction, 15% is good. Production taxes, I mean, that's just going to be down to the lower price of gas. So like that to me was irrelevant. But yeah, the LOE I sort of saw as a negative. G&A I saw as a negative, but arguably these are negatives in the short term because, acquiring East Texas too, I mean, they're not going to lay everybody off on day one and say, sorry, lads, off you go. They're going to keep them on. They're going to rationalize it. They're going to sort of streamline it, repurpose people, do all sorts of usual, and then there'll be natural attrition of people leaving and this and that, performance managed, whatever. Yeah, that those costs will come down, and that's the synergies. That's the 50 million, part of the 50 million of synergies. So, like, I didn't see it as a massive negative, but I did hope to ask that question of Rusty and Co. But anyway, uh, depletion was up quite a lot as well. These were negatives. So employees were up. And again, I think that's just related to the acquisitions and the people they've brought on. There'll be duplication of, you don't need double the number of accountancy staff and double the number of HR managers and double the number of all the back officey stuff. There'll be rationalization of these costs. But yeah, this one, there was a note in the accounts to say that partly because of the DP Lion disposal, but also the decreasing the estimated proved reserves relative to the depreciable base caused this depletion value to spike by quite a bit, 20% period on period. That's half to half. 20% higher nearly, and yeah, that's something as a negative as well, but lots of positives. So just trying to whiz through these, thought that was a massive positive. A, there's lots of land, but B, the land is going for 20% above what they said it was going to go for. Now whether that's sort of broad, that's like a more sort of recent land sales were this, whether that's indicative of future land sales, who knows? But certainly a positive. Certainly a positive. If these millions and millions of acres are going to go for 20% more than what we think they'll go for, then that's a real positive. The increase to the Appalachian gas that it can tap into zone 5. Zone 5, by the way, runs down through Virginia and then taps into this East Coast gas line that then runs down to the Carolinas, and I think it connects upwards as well, but doesn't go quite to New York. But it's a kind of East Coast um, gas line as well. So that's a huge positive, and that what I've done is repurpose the numbers into barrels of oil equivalent. But for me to have that as sort of further evidence that we're going to see higher prices, and obviously these higher prices, these zone fives, potentially for the data centers. I mean, we're that they're going to be in the zone fives. There's a lot of data centers in Virginia, which is where this zone 5 is. So that for me was a massive positive as well. The yeah, obviously leasehold, the sale of land. I mean, that's sort of not a new positive, but it's a further continuation of the positive. This tripling, I didn't expect it to be as much as a triple. So again, that's exceeded expectations really, and that's kind of that's probably going to be a combination of tax credits and actual sale of the gas itself, and I think that they're going to be trying to purpose these as part of the data center thing as well, because then you've got net zero credits and different things, carbon credit offsets that is very attractive to data centers, because they're competing with data centers in places like Iceland, that they can say, oh, it's all renewable energy, and data centers in Brazil, oh, it's all renewable energy, and that everybody, data centers are very sniffy about having clean energy. That's actually a really big thing, and a lot of contracts will insist upon that. So the more that DEC can kind of play that hand is a positive. Obviously, not much about the LNG contracts, but that's sort of not going away. There's more and more positivity about that. The expansion of the next LVL, again, that's not new news as far as I was concerned. That but the fact that they said today that they're going to be expanding capacity in 2025. He was asked about the lower number in 2024. He said, look, we're going to be addressing that, and yes, there was some bureaucratic something or others in 20, who knows, but yes, that's going to be an area of focus in 2025. The yeah, just generally that the prices are much higher, and demand is forecast. So this is the forecast demand uh, 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 um, going into the new year, and yeah, so, and then this is the capacity levels of LNG plants versus historical levels. So 6 months ago they had all these orangey bits, which were the spare capacity, and we can see here, this was as at February, that the orange has almost disappeared, that they're all running at nearly or at 100% capacity. So yeah, really positive. Um, yeah, so couple of negatives as well around the next LVL revenue versus last year, but um, and this bit here was where I then sort of started looking at the derivatives and said, well, what is this 67.4 million loss, fair value loss? And I said, well, look, if there's a swap at $3.30, then, and that's based upon that volume there. I mean, I started off by taking that volume being just that volume, and that worked out to be sort of $600 per million British thermal units, which obviously is ridiculous when it's, we're talking about something that costs $3 being a $600 loss. I mean, that's obviously not the case. Or no, maybe it was a $400, but it was a large number. It was maybe 330, a $330. Yeah, actually, that divided by 200 would be about 330. So that kind of didn't add up. So I thought, well, this must be a daily value for over a year, an average daily value over a year. So when I did that, it worked out at 86 loss per MMBTU, which, on something that costs about $3, that sounds actually about quite right. So on a 330 swap, that would imply that the fair value is sort of saying it should be, the fair value would be of the gas is 416. So it's kind of saying, well, on the basis that future gas could cost or could be priced at 416, which actually was the price of gas last Friday. I don't think the 2024 accounts is using the 14th of March as the um, reference rate. At least I hope not. But they would have decided upon that 416, and they don't say where they get that 416 from, but somewhere along the way they're kind of getting this, because it must be that, because how else would you arrive at a 67.4 million loss on that much volume at that price if it wasn't that? So but anyway, that relates to something that's happening a year later in 2025, in this year, when there's going to be, sort of, revenue. So it goes back to this thing where to kind of look at these accounts properly, you've got to just strip this stuff out. You can't leave it in. Well, I mean, accounting rule means you do, they have to leave it in. But for you and I, as sort of people wanting to interpret and understand these accounts, you've got to strip it out. And when you do, what you see is that, the assets of the business, the net asset value grew year on year, not by a massive amount, by 20 million, but bearing in mind that includes this increase to the decommissioning costs. So decommissioning did increase by quite a bit. So that's another a negative. Part of that is, of course, the acquisitions, and part of that was there was a slight increase to the calculation as well. Obviously, borrowings increased as well. Everything else, obviously, taxes slightly dropped here, leases slightly increased. So all of this is kind of much of a muchness. You can see there, like current liabilities, 3 million. It's like all of the stuff here that I've not highlighted is pretty much just not relevant. But yeah, that was largely sort of, a take on of extra assets and extra liabilities to kind of, but I suppose the point I then make is, well, if those extra 400 million of properties can be earning a return, um, and earning cash flow and earning things in excess of the cost of that extra borrowing, then it's a good thing, because the profits increase, and that's what affords dividends, and that's what affords repayment of debt, and so on. That's business. That you've got to make more than it's costing you. You've got to make a profit and then you use the profit to pay down liabilities, to pay dividends, and everything else. So yeah, to me that kind of felt like actually quite a good, strong balance sheet, even though the level of cash is minuscule and the obviously the absolute level of borrowing is high relative to how much profit this is making. It's controllable, it's not out of control, far from it, in my opinion. So I think that's pretty much it. We're at 30 minutes, so it's a bit slower than I know people sort of say it's terribly boring to watch these videos. If you think that, then don't watch them. It's really easy. Just don't watch them. Don't put yourself through it. But for those that actually do want to understand a share like this, hopefully these videos are useful. I mean, give it a thumbs up if you agree with that statement, and obviously just don't watch my videos if they're not useful for you. Just I don't know why would you watch them and then have a moan about watching them? Just don't watch them. I mean, come on. Like surely that's surely that's common sense. But there we go. Not all sense is common, I guess. Anyway, this is Oak Bloke. You can read my articles on Substack, theoakbloke.substack.com. Hope this has been useful. Give it a thumbs up if you think so. And cheerio for now. Cheerio.